Hello everyone, Nicole here from Momentum Accounting. In this video, I'm going to be going through showing you what happens with your cash when you're growing business and why businesses that grow too fast sometimes end up failing or struggle with cash flow. So this all comes down to the cash conversion cycle, which is basically when you invest in a piece of inventory or a person, how long does it take to then turn that cost into cash for you? So in this case, my assumptions are going to be, and let me just zoom in here a little bit more. The assumptions I'm working off here are that you are a service-based business and you hire an employee. Your team is at max capacity, so you want to hire a new employee so that you can continue to grow. So we're going to assume for easy math that this employee costs $10,000 per month. And then we're also going to assume that it's going to take 4 months for them to be at max capacity, where they're actually fully generating the max amount of revenue that they can. So if we look at this as scenario one, we can see that our cost every month is $10,000. That's their salary. And then their revenue that they're generating month one, we just hired them. They're getting on board trained. They're not generating revenue. Month two, they're generating $10,000. So they're at least covering their salary. Then we're making a profit on them. Then we are at max capacity. So we're making that 50% margin on their labor basically. But here's the thing. What if our company does not get paid in the same month that we generate revenue? So then now let's go ahead and assume that after we generate revenue, we send out invoices to our clients and then they pay us 30 days later. So as you can see here, we've got the cash being collected 30 days after the revenue is generated. So month one, obviously no cash generated, no revenue generated. Month two, we generated $10,000 in revenue, but we are collecting last month's revenue. So zero there. So by month three, we're at least breaking even cash flow wise. And then we get up to our $20,000 a month in cash generated. Now, so you can see the net cash out in month one was negative 10,000. The cash out was 10,000. Month two, cash out another 10,000. And then by month three, we've broken even. Now, finally, by month four, so it took us 4 months to actually start generating cash from this employee, and then 5 months to max out that cash. Now, if we actually look at the cumulative cash, we can see that cumulatively the highest cash, we had to output $20,000 total to start generating cash from this employee. And it took us 6 months to get back to zero cash out. So that is the impact that hiring a new employee takes. It takes us 6 months to basically get to a point where we are back to cash flow neutral. And now this employee is going to start, now we're going to start building. For burning cash, then we're going to start building cash. It takes 6 months. So that is why, if you can imagine, if you've got multiple employees that you're hiring people really fast, how that can extrapolate. Now, let's say that your company is really bad with collections, or you have slow paying customers, or maybe you work with enterprise companies that only pay you in 60 days. In that case, we've got ourselves in an even bigger pickle. So let me just hide that. We'll come back to that one. So in this case, same scenario in terms of employee costs, revenue generation. The only difference is now we have to wait 2 months to get paid. So we don't start collecting cash until month 4. So our cumulative cash out is $30,000. It takes us 8 months before we're not burning cash anymore and we're starting to build cash. And it takes us 5 months to even start being cash flow positive on this person. So that is why if we can do anything possible to get our customers to prepay, to pull money from our clients' bank accounts or auto charge them, use credit cards processors, use ACH processors, use technology to get money in the door faster, that can make a huge impact on our business. So in this case, in this example, cash is collected in the same month that revenue is generated. So we can see we start collecting cash in month 2, same month that we generate the revenue. Boom, boom. And we only actually have to lay out $10,000 in cash. And by month 4, we're not burning anymore. We're making cash. And by month 3, we're cash flow positive. So that, my friends, is why when I tell you to please get paid up front, to please use electronic methods for getting paid, this is why, because you can literally go bankrupt if you let your AR get out of hand. I'm Nicole, I'm the founder of Momentum Accounting. We help our clients improve cash flow and profitability and set up their financial operations in a way that helps them be more efficient. If you want to learn more about what we do, you can go to momentumaccounting.com, and I'll see you in the next video.